Let's get reaction now from our roundtable. FTN Financial Chief Economist Chris Lowe, Brandeis University Economics Professor Brandeis Mann, and of course our Economics Editor Tom Keene. Tom, let me begin with you. Anything in the language jump out at you?
I think what jumped out is it was a very safe statement. It had a bit of a dovish tendency to me in the sense of
too safe, perhaps.
I'll let Professor Mann and Mr. Lowe pontificate on that. What I'd say is it moved the market a little bit. The 2-year came in 2 basis points. Now it's in 1 basis point. We're from where it was at 215. As Sarah said, not much reaction in the dollar market. Again, a sigh of relief, and a Fed maybe on a different timeline than what the media is on and what the market is on. There's a patience there that Professor Mann was speaking of earlier.
Chris Lowe, the movement or lack of movement today by the Fed repeating its pledge to keep interest rates, the quote here, was exceptionally low for an extended period. This isn't a surprise, is it?
No, I'm not surprised by that. I think, if anything, I'm a little bit surprised at just the lack of elaboration on the economic and inflation assessment, and that tells me that they're very comfortable with where they were a month ago. So you don't even have the setup for thinking about maybe at some future time changing the direction. We're going into this meeting and comfortable with where we are and where we're going.
Professor Mann, were you looking for a little bit more substance as well?
Well, I did hear a little bit of a substance there with regard to the unemployment or the labor market situation being unabating and not quite so dire. And I'm actually a little surprised to hear that, because if we decompose the economy into its 2 major components, which is manufacturing and non-manufacturing, yes, we have seen some better data on the manufacturing side with regard to production and employment. But on the non-manufacturing side, which is, of course, much larger, the unemployment situation has continued to worsen for 18 straight months, according to the ISM. So I'm a little surprised that unemployment discussion suggested an upturn which is what I don't see.
Was this a question, and Crystal, let me go to you on this first. Was this a question of a Fed just trying to get into next year? It's December. The chairman has a date with Congress tomorrow. He's going to get confirmed. I mean, obviously, this statement not amended by the confirmation process, but is this just a Fed trying to get to that later January meeting?
I think to some extent that's right. I would never ever question the Fed changing a decision, making policy for political reasons.
No, you wouldn't, but Bernie Sanders would say so.
No, but that's not this group. But what they will do, why tempt fate? Why go into a confirmation after saying something inflammatory? So if there's no need to do it, don't do it. And I do think that's one of the reasons they're playing it so safe. The amount of elaboration in the statements the last several meetings has been toned down. And remember those op-eds in the Wall Street Journal? Very fiery sort of anti-inflation stuff in August and September.
Professor Mann, is this a chairman and governors and presidents that are distracted away from monetary policy by the bigger issues like Fannie, Freddie, not so much 2010, but into following years? Or you look at Governor King's speech in Edinburgh about breaking up the British banking system. Are they focused on monetary policy, or is there a sense of distraction in the Eccles building?
Well, I don't think there's a sense of distraction, but there always is two heads and 2 minds there at the Federal Reserve, one having to do with bank regulation, the other one having to do with monetary policy. I would agree with Chris that there's a sense in which there's a little bit of autopilot going on with regard to monetary policy right now. But I am concerned that autopilot generates these asset price, I won't call them a bubble yet, but there's certainly increases in asset prices, commodity prices that are really not warranted given the state of the economy. We all know that asset prices, particularly stocks, move in advance of the economy as a whole. But I think few people would argue that the current level of stocks makes sense given the strength of the economy in the near term, really over the next 6 to 9 months. So I think that there's a bit of a tension there that they should be paying a little bit more of attention to.
Well, Professor Mann, this is Chris Lowe. I'm just wondering what you think about service inflation. We had the CPI this morning. Yes. You can see the owner's equivalent rent is just tumbling, 24.5% roughly of the CPI. So you do have these service-driven costs which are tied to the unemployment rate coming down. Doesn't that offset some of the pressure in commodities?
Well, certainly, if all you care about is the top line number, then it's okay if the two components cancel each other out. But I think that what we need to be thinking about is, what do commodity prices tell us about the underlying conduct of monetary policy,
right,
and how investors think about what they should be doing with their money. When you have very low interest rates and no real economic activity to make it attractive to invest in real plant and equipment, or
right,
software, or whatever you want to call it, real economic activity, then you just have a lot of frothy investment in futures and so forth, and you're not getting the credit to go to where it really needs to go in order to produce a sustained recovery. That's the problem that I see.
And Professor Mann, we're going to have to leave it there, but we thank you so much for your input. Professor Catherine Mann, Chris Lowe, our economics editor, Tom Keene. Thank you all so much for joining us.